Hi, this is Dustin Hobbs of the California MBA. Welcome to Connect, our monthly podcast featuring one-on-one interviews with movers and shakers and headliners in the industry. This month, I'm excited to have Mitch Kider here with us. Mitch is the managing partner with Weiner Brodsky Kider, based in Washington, D.C. Mitch is out here in California. We're actually in Newport Beach this week for the annual California MBA, Western States Focused Legal Issues and Regulatory Compliance Conference. And Mitch just actually finished up a panel a little while ago on the CFPB, so I know he's been studying up on them and definitely up on what's going on in the industry. Mitch is one of the most respected attorneys in the industry, so I'm really excited to hear his thoughts today. Before we get started, I wanted to say a little bit about the California MBA. If you're not familiar with the California MBA, maybe this is the first time you've heard our podcast or been introduced to us. The California MBA has been around since 1955. We represent California's mortgage banking industry, the real estate finance industry here in California. And we represent both residential and commercial mortgage bankers. And we do that before the state legislature, the governor, and all the regulatory agencies in the state. And the one thing I'll mention that is of particular importance, especially in this atmosphere at the conference today, is that when regulatory decisions are made in California, they have a way, and I'm sure Mitch can attest to this, they have a way of making their way across the country and sort of filtering out in the other states and maybe even in the federal agencies. And so what happens in California is crucial to the country and to our industry. So, all right, Mitch, with that out of the way here, I wanted to jump in. And before we get into sort of the nitty gritty on the industry, I always like to ask this question. It's always of interest to me, especially. What's your background? How'd you get to where you are at Weiner Brodsky and what's your journey?
So it's an interesting story, actually. Housing finance is something that I've actually been interested in ever since I've been a little kid, to tell you the truth. I am the son of immigrants, people that survived World War II, survived the Holocaust, came to this country, purchased a house with an FHA loan, and ever since I can remember, they told me about lending. They told me about how they borrowed a loan to purchase a house. And when you're an immigrant, and especially one that was in the Holocaust, my mother was in a concentration camp, my father fought in the woods alongside Russian partisans, they basically didn't have roofs over their heads. House was very important to them. And that was ingrained in me, and housing was really important to me. And I was always intrigued and interested about how banks handle the finance process itself. I could take you years later. I went to school in Madison, Wisconsin, University of Wisconsin in Madison. I was there for about a week. I called up the mayor of the city, and I said, I'd like to come work for you. He said, what kind of things interest you? I said, housing. And I went to work for the mayor as a volunteer, and I worked on housing-related issues. Started the first tenant-landlord rental relation board in the country, in Madison. And from Madison, I went to a school called Washington University in St. Louis School of Law, one of the best law schools in the country. And I actually went there because there was this specific professor. His name was Daniel Mandelker. He's still alive. He's about 95 years old now. And Dr. Mandelker was one of the icons when it came to housing and urban law, wrote the textbooks. So I spent 2 years as his research assistant, helping him write textbooks, helping him write articles, learning all about housing finance, Ginnie Mae, Fannie Mae, and Freddie Mac, and everything else that was going on in the industry. And these are cutting edge times, because this was, in the very early 1980s. And when it came time to, I realize this is probably a longer story than you were looking for, but I'll tell you. When it came time to graduate law school, I thought about what I'd like to do, and I've always been a good litigator in law school. At least I won mock trial competitions, moot court competitions, and I wanted to mesh the two together. And so the professor I worked with told me he knew the general counsel of HUD very well, and I went to work at HUD as an honors intern, basically regulating mortgage bankers and litigating with mortgage bankers and working with the Justice Department all along the way in various U.S. attorneys' offices. I tried a case against a law firm. I won. They hired me, and that's how I got into private practice.
Can't beat them, join them. Huh?
In 1992, I started this firm with two other people, Harvey Weiner, Jim Brodsky, and myself. We started it. We've grown it. And this is what we do. We represent mortgage bankers all over the country. We do their major litigation for them. We do their M&A work for them. A lot of bank M&A work. We do the mortgage side of that bank M&A work itself. We do their regulatory work, really, in all 50 states and the federal government as well. So we decided when we started this firm, it was going to be full service to this industry group.
Well, that is I have to say it's fascinating in the sense that I think this is our 10th episode now, and I've yet to find someone who started out in the industry or had their path focused on our industry so far back. So many people, it's they kind of fell into the industry or they were doing something else, and then fell into mortgage banking and found and loved it and stayed in it. But
Sure.
I love the fact that it's been your passion for that long. That's really fun. That's
well, provided the American dream for me. I mean, basically, two parents came here with nothing in their pockets. They had a house. They sent both my sister and I both to college, to law school. They managed to afford it. I have a family. I have 3 sons. They're all professionals, 2 lawyers, and one who's vice president of a private equity firm. It all starts somewhere, quite frankly. And in all honesty, a lot of that started with the equity that my parents built in that house that they were able to use.
Yeah, that's great. That's great. I've got 4 kids myself. That is the American dream. Absolutely. All right. So jumping into your specialty here, litigation. What would you say? What's the hot topic in litigation these days, or maybe going into 2020?
Well, there are a number of hot topics in litigation these days. So the Telephone Consumer Protection Act, the TCPA, is a very hot topic these days. And the question of what is an auto dialer and what is not an auto dialer. And that ultimately may be decided by the Supreme Court because there's a split in circuits. But there's a fair amount of litigation and a lot of exposure for mortgage lenders that are using auto dialers and making calls along those lines. So you see a number of those cases that are coming up. The Fair Credit Reporting Act, not in terms of traditional credit reports, but in terms of investigative credit reports and credit reports that are being had for trigger leads and things of that sort, is causing a fair amount of litigation today as well. And I think that's going to continue on. We're starting to see the beginning of a number of suits that deal with data breach and cybersecurity breaches. And that's just going to continue over time. And when you look at what's happening with California and the CCL Act itself, there are statutory damages in here. So soon you won't even have to show actual damages to be in court. So these are all areas that lenders should be thinking more about and looking more about in terms of third-party litigation.
Yeah, well, I'm sure especially the CCPA stuff out here in California, that'll come up. We're having at the conference tomorrow, we're going to be focusing on CCPA. We have a couple-hour workshop that I'm sure will focus on some of these issues. So what about class action? Is there any major class action litigation that we should keep our eye on?
Well, there's a lot going on with class action litigation. Over the years, I've actually defended more than 150 class action lawsuits. And so here's the way to look at class action lawsuits in terms of what to look out for. Plaintiffs' attorneys, they're professionals. And I view them as entrepreneurial litigators. What do they sue over? They sue over anything that's been successful. So they watch each other. That's the way it all started with escrow class action lawsuits. A couple of suits were filed back in the 1980s, and that was really the first time anyone was going after mortgage lenders. A couple of courts looked upon those and thought there might be something there, so then everyone jumped on that particular bandwagon. So you get these class actions 2 ways. You get them because attorneys jump on things that work, or you get them through the news. And so if you read a settlement, it's about a respite case. If you read a settlement that deals with any type of a regulatory issue like loan originator compensation, you are likely to have that followed with some type of a class action lawsuit. They see what's in the news, so they see what otherwise works. But in terms of what the real big issues are now, they kind of permeate all class action lawsuits. And they really deal with statute of limitations. That's what it deals with, okay? There's an effort that's being made, and that courts, or a number of courts, are actually buying off on to extend the statute of limitations. There's a theory called fraudulent concealment, okay? And that results in equitable tolling. So, for example, a consumer has a 1-year statute of limitation under the Real Estate Settlement Procedures Act, under RESPA. But courts are holding that the consumer might not have known of the violation, and you may have fraudulently concealed that particular violation, okay? Even though the consumer really has to show that they made investigation. But Courts are moving away from that as well. There's a case that just came down in the Fourth Circuit that said that even when a plaintiff knew of another lawsuit, okay, they would not attribute knowledge to them, and they allowed equitable tolling in the case itself. So there's this expansion of the statute of limitations, and that's going to make a very big difference in class action lawsuits. In RESPA, there's actually a split in circuits that's happening now as well. So the seminal case on this is a case named Snow, and it came out of the Fifth Circuit Court of Appeals. And in Snow, it dealt with the issue of when is there a RESPA violation? When does that violation occur so that you can toll the statute of limitations? And the Snow court held it has to be when the loan closes. So the loan closes and the statute of limitations goes from there. Okay? That's when you start to toll that statute of limitations. But now there's a split. Here in the Ninth Circuit, courts have held no, that's not necessarily the case. In an MI case, in the mortgage insurance case itself, the court just held that, in fact, every time a mortgage insurance payment is made, that's a new thing of value that's being paid, and that re-ups the statute of limitations, and you start all over again. And that's happening now. There are 3 or 4 circuits that go along those lines. Apply that to other federal regulatory requirements and statutes itself, and basically you find yourself in this endless cycle without a statute of limitation. So those types of cases are really important. They need to be watched out for, and you'll see them eventually make their way up to the Supreme Court.
I was going to say, yeah, I mean, if there's a split in the circuits like that, it sounds like we are headed to a Supreme Court decision at some point.
Yeah.
Or multiple ones.
Yeah, absolutely.
So speaking of the Supreme Court, I think everyone in the industry has kind of had this, in the back of their minds, focusing on it, occasionally when it pops up in the news over the last couple of years. But I just read, a couple of weeks ago that the Supreme Court may take up the CFPB's constitutionality. And so I'm just curious, what do you see? What is the future like? What's your take on where that case is headed?
Yeah, so it's fascinating, actually. And, we started it all when I started with the PHH case, which I litigated. That was the first time. Oh, yeah. I litigated that case. I tried it, took it all the way through the appeal. And that is the first time we challenged the constitutionality of the CFPB. So it's really interesting for me to see what's going on today. So the Supreme Court said they will hear the Saylor case. Saylor case comes out of the Ninth Circuit as well. And, I think what's ultimately going to happen is the Supreme Court has to look at whether or not the structure of the CFPB is constitutional. And so the question is, first of all, the CFPB is believed to be an independent agency. For years, since the beginning of independent agencies, probably back in the 1930s, people have questioned, where does that come from? You go to school and you learn about 3 branches of government, right? Well, where did this 4th branch of government come from? That's the question. So there have been many people that have really wanted to challenge that ever since a case in 1935 that was known as Humphrey's Executor. And in Humphrey's Executor, it involved someone at the FTC. And back then, the Supreme Court said, no, it's an independent agency, but it's okay because it has a commission and it's self-checking, and you have Democrats and Republicans. And so it's not a political agency. It's really an agency that's there for its expertise. Well, now we have these independent agencies with just a single director that the president cannot get rid of. And these agencies like the CFPB, they are providing executive level business. That's what they are, and they belong in the executive level. So the question here is, beyond the issue of, where does this 4th branch of government come from, is this really a separation of power? Isn't it the president that should have the power over this? This is an executive level agency, in practice, in theory and in practice. Yeah. And yet, if the president cannot terminate someone at will, that person can go forward with policies that are adverse to the president's policies themselves. What do I think is ultimately going to happen with that? I think the Supreme Court's going to recognize that. I mean, there's already one judge there that has, because Judge Kavanaugh ruled on that in the PHH case, and he wrote the decision for it. So the court has a choice. The court can either strike out if they find the structure unconstitutional, which the CFPB themselves now says is unconstitutional. The court can strike out the 4-cause provision, so a president can, in fact, terminate the director of the CFPB with or without cause, or the Supreme Court could strike the entire statute. They could strike Title 10, send it back to the House and Senate, and say, do it all over again. Regardless of where their ideology is, courts do not like the idea of being disruptive to the point of saying everything an agency did is wrong.
Yep.
The more likely result is they're going to write out the for-cause provision itself. And that's going to make some dramatic changes. You will see a difference at the CFPB. If you have a new president at the next election, you can be sure that president's going to want their own person to run the CFPB. It's actually going to make the CFPB even more political. Because if you look at cabinet level agencies, those are all executive agencies, and they all serve at the pleasure of the president, and they're all selected by the president with advice and consent of the Senate. And that's what will happen with the CFPB itself. And every president will have the ability to pick their own. We'll see. I think that's probably what's going to happen, although beyond the Supreme Court determination, it makes sense to keep an agency like the CFPB, or to create an agency like the CFPB, because they've always been political, to create an agency like the CFPB as a more independent agency. And what I'd really like to see, ultimately, when this is all done, is Congress saying, no, that's not the way we want to do it, and creating a commission like the SEC, like the FTC. But that's further down the road.
Yeah, it seems, the idea, it shouldn't seem like it's impossible, but the idea of Congress getting together and, making changes to the CFPB like that seems like a Herculean task at this point.
Yeah, it does. It does at this moment in time. But 2, 3, 4 years down the road, who knows?
Let's hope. Yeah. So speaking of the CFPB, taking the case aside, what do you think will be their compliance and enforcement agenda going into 2020?
So their enforcement agendas is interesting. The philosophy of Kathy Kraninger, and I think it was the philosophy of Mick Mulvaney, but he wasn't there very long, is really, we're going to find violations, and if they are real violations and it's clear under the law, we're going to go after those violations. I think the first thing to note is they put an end to regulation by enforcement, which really was the manner in which Richard Cordray did business at the CFPB. So that's good. And the overarching philosophy is, we're going to look at the statute, we're going to look at the regulations, and if you violate it, then you're going to pay a price for it. Okay, and then they're going to look at the egregiousness along those particular lines. So that, I think, is their top priority. If you want substantive areas that they're going to look at, I think it's fair to say that 2020 is going to be the year of the veteran. It's a political year, it's an election year, and you already see a number of different agencies, including the CFPB, investigate different matters as they pertain to veterans. There are a number of different civil investigative demands that deal with direct mail solicitations, that deal with IRL loans and streamlined refis, and whether or not there's a tangible benefit. You see it at the CFPB level. You see it at the Justice Department level as to compliance with the VA guarantee program. You see states that have already entered into consent orders and settlements with some VA lenders on the basis of their advertising itself. So that's going to be a high priority, and that program is going to be scrutinized tremendously. That leads you into other issues like fair lending, which is always a high priority in every administration. It has been since the first George H.W. Bush administration, when we had our first major fair lending consent orders that were issued. That's not going to change in this administration either. That's a big issue. That's a civil rights issue. So you're going to see that there. And finally, I tell you, a priority that isn't going to go away, and it's very dangerous for lenders, is UDAP. Unfair, deceptive, and abusive acts and practices on a federal level, but not just on a federal level, on a state level as well. Unfair trade practice acts. And I think one of the biggest issues facing lenders are state unfair and deceptive practice acts themselves, because those acts, and they talked a little bit about that in my session just before, those acts aren't necessarily statutory violations. There aren't statutory laws, there aren't regulatory laws that say, do this and you're violating the law. Do that and you're violating the law. They're much more amorphous than that. And so that's hard to get your arm around, which really means that lenders have to really ask themselves, when they have their policies and procedures, when they look at what those policies are and how they lend, they have to look at it closely to see whether or not they think anyone's going to get hurt by it, whether or not they think someone is being fooled by that practice or doesn't fully understand it itself, to make sure they don't get caught up in those types of actions as well. These unfair and deceptive practice acts, they extend statute of limitations, and they come with statutory damages, they come with additional penalties as well. And I think that's probably one of the biggest issues that the industry is going to face going forward.
Do you see a particular state that is taking the lead in that?
Well,
I mean,
the reality is we're sitting in the state right now that has the civil code provisions to back it up and that aggressively pursues those types of actions. California probably is on the very top of that list.
I guess I should have said aside from California. Yeah, California being the obvious one. Yeah. All right. Well, so sticking with sort of what's going on at the federal level, what do you think? What's the fallout after the QM patch expires next year?
Well, I mean, we'll see. Hopefully there won't be much of a fallout because they'll do it in a thinking fashion. I think it depends on what happens. I don't think the QM patch is simply going to expire without anything else. I think one of two things will probably happen. You'll either get a shorter temporary extension as they try to work out how to deal with the issue, or you'll get the situation where they revamp QM ATR ability to repay, and a lot of those consumers that otherwise could not fall into a straight out QM loan but for the patch may be defined to fall into that QM loan. If that doesn't happen, the fallout's tremendous. If they don't look at the consumers that are the beneficiaries of the patch, you're going to find that there's going to be much less access to credit for lower, moderate income, and even middle income people, quite frankly. You're going to find that lenders are being squeezed along those particular lines because volume is going to be down as well. Sure. So the industry will be hurt by that as well. And we're going to look like some countries do, where it's very, very difficult to get a loan. The QM patch has been really important, not just because of the 43% DTI ratio, but because it also allowed lenders to underwrite to the agency guidelines, to Fannie and Freddie guidelines. They have to underwrite these loans to Appendix Q. There are many worthy borrowers, credit-worthy borrowers, that simply will fall out. So we'll wait and see. I mean, the CFPB issued their advance notice of proposed rulemaking last summer. My guess is that somewhere mid-2020, you're going to see some type of a proposed rule or hear more about what their plan is. I hope, and I find it hard to believe that anyone in the government is just going to let it fall without taking care of this situation. I think that'd be very, very irresponsible. So we'll see.
Do you think that there is a sort of a permanent fix to that within the regulatory agencies themselves, or is this something that Congress is going to have to address at some point?
No, I think ultimately Congress is going to have to address this, quite frankly. That's where I think that's come from. And, it plays together with GSE reform and things along those particular lines. And, GSE reform is something that's been talked about now for 11 years. So it's going to take some time.
Yeah, I keep hearing the same thing. Yep. So switching gears a little bit here, what's your advice? And I loved your backstory, fits perfectly into this. What's your advice to any younger attorneys or would-be attorneys who are interested or looking at, sort of where they want to put their focus in? And if they're looking at mortgage finance, what's your thoughts and your
Well, first advice? I'd say it's a great area to be a lawyer. I mean, I've done this for a very long time, and the truth of the matter is I enjoy every day. I love being an attorney. I manage my firm. I could probably live without some of the HR issues as they come up, managing people from time to time. But in terms of being an attorney, I love it. I love working with clients, and I love what I do. And I think a lot of attorneys will find a lot of happiness in that area. But my advice to attorneys who want to get into mortgage banking, and to tell you the truth, I give them this advice in other areas as well, is you actually need to know more than just the law. It's not enough to read a regulation. It's not enough to read a statutory provision. You need to know your client's business. Because if you don't know your client's business, you don't know how you're going to help them solve those problems. And a good lawyer is really a problem solver. That's really first and foremost what a good lawyer is. And so what I really enjoy about my practice in the firm that we created is we decided to create it around an industry. And we decided that there isn't going to be any other law firm out there that knows and understands this industry as well as we do. And to that, we added really good attorneys, okay, to provide prime service. So that's what I would say to young attorneys. Don't just look at it as, oh, I can walk in and litigate any case. And I hear that all the time. Or I can just go do any deal along those lines. Understand their business. You're not going to know when to say no, and you should not say no all the time. And you're not going to know when to say yes. And you're not going to know what the right alternative is to be able to help your clients unless you learn their business. And that's what's critical.
Lots of homework.
Yeah.
All right. So sort of our closing thoughts here as we end. What's your thought on sort of what lenders don't know that they should know, or what's the biggest threat that you see out there aside from what we talked about? If there's something else out there that maybe should keep them awake at night, maybe doesn't.
So, I actually think most lenders know what they need to know. It's taken a while to get there. If you asked me this question in 2007, you would have had a very different answer. But I think most lenders are doing a pretty good job. I guess I would put two things in the category of what lenders might learn a little more about, quite frankly. And one is this CMS, the compliance management system. Especially small, mid-sized lenders themselves, they may have a decent system when they recognize a rule or regulation of implementing it or doing something else along those lines. But a CMS is much broader than that. A CMS is out there to protect you. It's to, number one, make sure you get it right. Number two, if you don't get it right, make sure you're on top of it and you catch it right away. Make sure that, you don't end up with systemic problems themselves. And when the CFPB first came into existence, a lot of lenders found themselves behind the 8 ball, and they were trying to catch up on compliance-related matters. They tried very hard to catch up, and they did. They did. It took some time, but they did. Lenders need to know that they need to keep that up, and they have to have an all-encompassing CMS system to ensure that they'll be in good shape. And some lenders think, well, different administration, maybe the rules are going to change, maybe there's, they're more lax on enforcement or something else along those particular lines. That doesn't work. That's just a recipe for disaster itself. The last piece that I will tell you that lenders need to know, because I actually just did a webinar on this, because I found it to be really important, is reporting requirements. Lenders are going to have problems. It's the nature of the business. You're going to find something went wrong on a loan. Someone did something wrong. It could be a third party, it could be someone in your company, but there are reporting obligations. FHA has reporting obligations, and they have annual certifications that they just changed, and they have loan level certifications. Those certifications have been used by the government in False Claims Act prosecutions. That's a problem, okay? States have notice requirements as well. Lenders should have and create a matrix of all of their reporting requirements. If something happens, what's my reporting requirement? When do I have to report it to, and who do I report it to? I've actually seen tremendous sanctions placed on lenders, not for just not reporting, but for not reporting on a timely basis. And so that's something that lenders really need to start focusing on.
All right. Well, hey, Mitch, appreciate the time.
Hey, it's my pleasure.
Thanks for joining us here on Connect. That's all the time we've got today on Connect for this month's episode. Join us next time, and make sure and subscribe to our. You can subscribe to us on YouTube, on SoundCloud, or iTunes. That's it for this time. We'll see you next time.